Hello. Now it's that time of week again to discuss what's going to be shaping up the financial markets in the last week of March. Now joining me, as always, is our very own senior market analyst, Jasper Lawler. Jasper, thank you again for joining me. Now, we've seen quite a pullback in the US stock markets in the week just past, bearing in mind we've seen a massive rally on the back of Donald Trump winning the US presidential elections. Now, it appears to be about the delayed healthcare vote, but what's the market's real concern and how serious is this pullback we're seeing?
Well, we're putting a chart on the screen around now, I think, and it shows that this has been about a 2% pullback. This chart particularly is of Wall Street, our proxy for the Dow Jones, but it's about the same across most of the major indices. It's a 2% pullback from the highs. In the Dow, which has been one of the most powerful rallies, is up 20% since the lows right after the US election. So really the preceding rally dwarfs the size of this correction. So obviously this could be the beginning of a much bigger pullback in the markets, and that actually is my suspicion it could be, but we don't really have any proof of that yet. To my mind, we blasted through 20,000 on the Dow, we got to 21,000, and the market's just really overbought. And the healthcare reform, while I do think it is a proxy for how Donald Trump can push through other more important agendas for the markets, like tax reform, I think it's sort of an excuse, and I can actually see the market just drifting into a correction, whether the bill gets passed or not. I mean, it's already not made it through the Congress, and now it's going to the Senate, it looks like. It looks like it probably won't pass on this first iteration, but I don't think that necessarily matters. I don't see a collapse, I just see markets pulling back.
Okay, so we'll keep an eye on US stock markets next week. Before we dive in properly to next week, OPEC members and non-members meet in Q8 on Sunday. Could we see some wild moves in oil prices come Monday?
Certainly, potentially. So this is not a regularly scheduled meeting. It's between some of the key OPEC members and non-OPEC like Russia. I think really just in reaction to the oil price drop that we saw just a couple of weeks ago, the cuts that had been their output cuts, which had been supporting the price for the bulk of the year, they're getting unraveled right now. The market's losing faith that they're going to, in fact, cut as much as they have, as quickly as they promised, and obviously that in the whole context of higher US oil production. So this is a bit of a sort of emergency meeting on their behalf. I imagine it's the idea of it is a sort of face-saving, putting out some promises that actually the compliance will be better going forward. I don't think there'll be any kind of concrete measures like a promise to cut extra output or anything like that. But obviously if there was, that would really colour the whole movement in markets next week.
Interesting, very interesting. I mean, another big talking point on the agenda is without a doubt Brexit next week. So obviously the UK government are going to be formally triggering Article 50 on Wednesday the 29th of March. So we're finally going to start seeing the start or how we're going to be shaping up Britain's future. The big question, what happens next? Once it's triggered, now what?
Well, I mean, that's one of the most common questions that I get at the moment is, okay, when we trigger Article 50, particularly with the pound, does that mean we just see another collapse in the pound? That very triggering, what does that do in markets? To my mind, it doesn't make sense that should do anything. Obviously, the truth is hit, the reality is taking place. We are leaving the EU once that letter's sent off to the EU, but it doesn't really change or provide any extra information for us. So to my mind, there could be a knee-jerk reaction lower in sterling once that's actually a done deal from Theresa May. But to my mind, the motion in the market at the moment sort of suggests the pound is stabilising. Maybe not breaking out into a new uptrend, but it seems like it's kind of comfortable in this above 120 kind of zone.
Okay. I just want to take a quick look at this poll that we're going to be putting on the screen now, which I find quite interesting. And this was on who should have had the final say on Article 50. A lot of Leave voters felt it should have just been Theresa May. What's your thoughts on that?
Well, I mean, as you can see by this chart, it's pretty coloured by how you voted. But the majority do tend to think that actually the government should have the final say rather than it going to Parliament. That probably reflects the fact that the majority voted to leave. But I think it's also an acceptance by most that, okay, the country has voted, some cases maybe not voted the same way I did, but even for those people who think that, I think there's a desire to just get on with it. And Parliament, again, it very much depends on how you voted, but Parliament having a say, yes, adds a layer of democracy, but also adds a layer of blocking and delay. So, you can debate it either way. I think probably ultimately, as long as the negotiations, look positive, whether Parliament has a say at the end is actually a minor detail.
What else is on your agenda next week, Jazz? I mean, we've got UK and US fourth quarter GDP figures coming out towards the end of the week. Are they going to be interesting from a trader's perspective?
Ro, I don't think that those GDP figures are necessarily game changers just because they're rear view mirror stuff. They're the final iteration for the UK and the US of the fourth quarter of last year. We're obviously well into Q1 now. And for the UK particularly, given the Brexit uncertainties, European elections, that sort of thing, I would say that the signs are that Q1's looking a bit slower, and so that will be the real barometer for markets going forward. Just looking at last week, for example, we had some better than expected retail sales data in the UK, but over the 3 months, it's one of the biggest declines since, I believe, 2013. So it's a bit of a downturn for the consumer, and obviously that plays a big role in growth in the UK. So that past data not so important in my eyes as the data we're going to see forward for Q1.
What about the EU preliminary inflation figures coming out on Friday for March? Interestingly, I mean, as we know, Eurozone inflation hit 2% back in February, which was above the ECB's precious 2% rate. Well, just below they want it under. At the same time, I mean, we haven't seen this kind of level since 2013, but at the same time, core inflation did stay steady at 0.9%. So do you think the ECB is just going to sit tight on its current monetary policy and just wait for inflation to correct itself?
Well, I think they are trying to wait and see, obviously we've seen a big decline in the oil price. A lot behind the increase in inflation has been the oil price. So, you could argue if you wait a few months, that actually it is going to sort of taper off a bit, the inflation. So there is no rush for them. That's a distinct possibility. It might even be the right course of action. But there's going to be distinct pressure on them. If you just compare a very similar situation in the UK, we heard the chief economist Andy Haldane last week start to infer that actually he sees some rate hikes from the Bank of England. That's part of why the pound has been strong. If we hear anything similar from the ECB, in the light of this inflation data you're talking about, if it does continue to rise, then obviously that's very much a game changer for the euro. That would be a positive because it looks like ECB policy is turning the other way.
Okay, brilliant, Jasper. Thank you very much. Now, that's all we have time for in this week's version of The Week Ahead, but join us next Friday where we'll be bringing you the latest edition again. In the meantime, don't forget to connect with us on social media, and good luck trading. Goodbye for now.